Hello student, welcome to the lecture on pricing strategies and practices. And after this lecture, we will be able to learn the following objectives. Understand the concept of product pricing and pricing strategy. Understand the concept of factor pricing. Discuss the wages and theories of wages. Describe the rent and theories of rent. Explain the interest and components of gross interest. Pricing strategy refers to method companies use to price their products or services. There are several different pricing strategies. They are as follows. Penetration pricing. A small company that uses penetration pricing typically sets a low price for its product or service in hope of building market share. The primary objective of penetration pricing is to garner lots of customers with low prices and then use various marketing strategies to retain them. Price skimming. Another type of pricing strategy is price skimming, in which a company sets its prices high to quickly recover expenditures for product production and advertising. The key objective of a price skimming strategy is to achieve a profit quickly. Product life cycle pricing. A product gradually progresses through different stages in the cycle: introduction, growth, maturity, and decline stages. During the growth stage, when sales are booming, a small company usually will keep prices higher. Competitive-based pricing. There are times when a small company may have to lower its price to meet the prices of competitors. Temporary discount pricing. Small companies also may use temporary discounts to increase sales. Temporary discount pricing strategies include coupons, cent-off sales, seasonal price reductions, and even volume purchases. Concept of product pricing. Price is a key element in the marketing mix because it relates directly to generation of total revenue. The profit factor can be determined mathematically by multiplying price by quantity sold to get total revenue and then subtracting total costs. A cash discount is a price reduction for prompt payment or payment in cash. Geographic pricing involves reductions for transportation costs or other costs associated with the physical distance between buyer and seller. Zone prices are uniform within major geographic zones. They increase by zone as transportation costs increase. With base point pricing, prices are adjusted for shipping expenses incurred by the seller from the base point nearest the buyer. The term pricing method in the context of compiling price indices would probably be regarded by most price statisticians as a common concept. Cost-based pricing methods. No account is taken of market requirements, but a set amount is added to the costs. The disadvantage is that if costs increase, the price of the product must also increase. The following are examples of cost-based pricing methods. Absorption cost pricing. Used mainly in large department stores, the price of each product is dependent on how many costs it creates. Target pricing. A target price is made and then costs are adjusted so that price can be achieved. Concept of product pricing. Pricing method. Market-based pricing methods. Market-based pricing methods depend on accurate analysis of the market and consumer requirements. The following are examples of market-based pricing methods. Penetration pricing. Used for new products wanting to gain market share. The product is priced low so that it is able to get a hold in the market. Market skimming. When a new innovative product is bought out during the first few months, high prices can be charged as there is little competition and the product is popular because it is new. Competition-based pricing. Setting a price in comparison with other competitors. A firm has three options: price lower, price the same, or price higher. Product line pricing. Pricing different products within the same product range at different price points. Bundle pricing. The organization bundles a group of products at a reduced price. This pricing strategy is popular with supermarkets. Psychological pricing. Hitting price points that are significant. Example, INR 9,999 sounds better than INR 10,000. Premium pricing. The price set is high to reflect the exclusiveness of the product. Optional pricing. The organization sells optional extras along with the product to maximize its turnover. This strategy is used commonly within the car industry. Concept of product pricing. Pricing strategies. In terms of the marketing mix, some would say that price is the least attractive element. Our financial objectives in terms of price will be secured on how much money we intend to make from a product, how much we can sell, and what market share we'll get in relation to competitors. Objectives such as these and how a business generates profit in comparison to the cost of production need to be taken into account when selecting the right pricing strategy for the mix. The marketer needs to be aware of its competitive position. The marketing mix should cut into account what customers expect in terms of price. Economy pricing. This is a no-frills low price. The costs of marketing and promoting a product are kept to a minimum. Supermarkets often have economy brands for soups, spaghetti, etc. Premium pricing. Use a high price where there is a unique brand. This approach is used where a substantial competitive advantage exists and the marketer is safe in the knowledge that they can charge a relatively higher price. Such high prices are charged for luxuries such as Cunard cruises, Savoy hotel rooms, and first-class air travel. Penetration pricing. The price charged for products and services is set artificially low in order to gain market share. Once this is achieved, the price is increased. Skimming price. The price and the quality of the product remain high. Concept of factor pricing. 4 factors of production, that is, land, labor, capital, and organization are engaged to have a certain level of output. The distribution of rewards of factors of production is termed as distribution of national income or factors pricing. The ultimate objective of a firm is the maximization of profit, symbolically R-P. It shows that profit is determined by 2 components, that is, revenue and cost. Theory of factor pricing. The theory of factor pricing is also called the theory of distribution. Distribution is one of the important divisions of economics. In modern world, human wants are unlimited, so large-scale production is necessary. The large-scale production, in turn, necessitates large amounts of factors of production like land, labor, capital, and organization. The reward given to these factors are called rent, interest, wages, and profit. In theory of factor pricing, we study how the rent, interest, wages, and interest are determined. Wages. Wage and salary, income derived from human labor. Technically, wages and salaries cover all compensation made to employees for either physical or mental work, but they do not represent the income of the self-employed. Wages and salaries usually include remuneration such as paid vacations, holidays, and sick leave as well as fringe benefits and supplements in the form of pensions or health insurance sponsored by the employer. Monetary remuneration computed on hourly, daily, weekly, or piecework basis. A fixed weekly or monthly wage is usually called a salary. Theories of wages. Demand for labor. Demand for the laborer is derived demand. Factors of production are demanded because they have productivity or efficiency. Demand for laborers depends on the demand for the goods they produce. Laborers can be substituted for other factors of production. Technical factors also affect the demand for labor. Stated in money sit is called marginal revenue productivity. Workers are demanded up to the point where their marginal revenue productivity also labor's wage. Supply of labor. Supply of labor means the number of workers ready at the existing wage rate. On the other hand, the supply curve of an industry slopes upward from left to right. An upward rising supply curve of an industry shows the more of workers are employed at higher wages. Determination of the equilibrium wage level. Subsistence theory. Subsistence theories emphasize the supply aspects of the labor market while neglecting the demand aspects. Subsistence theorists argued that the market price of labor would not vary from the natural price for long. If wages rose above subsistence, the number of workers would increase and bring the wage rates down. If wages fell below subsistence, the number of workers would decrease and push the wage rates up. Wages fund theory. The proponents of the wages fund doctrine had been unable to prove the existence of any kind of fund that maintained a predetermined relationship with capital. Rent. The classical economic view. Classical economists of the 18th and 19th centuries divided society into three groups: landlords, laborers, and businessmen, or the moneyed classes. The concern of economic theorists was to explain what determined the share of each class in the national product. The income received by landlords as owners of land was called rent. Marginal land, the least fertile cultivated, earned no rent. It was also observed, however, that rent emerged not only as cultivation was pushed to the extensive margin, but also as it was pushed to the intensive margin through more intensive use of the more fertile land. All monopoly profits, it has been argued, should therefore be classified as quasi-rent. The intensive margin would exist even if all land were of equal fertility, as long as land was in scarce supply. It can be called scarcity rent, therefore, to contrast it with differential rent. Quasi-rent. The concept of quasi-rent was introduced in economics by Dr. Alfred Marshall. This concept is used for the surplus earned by man-made factors other than land. Quasi-rent accrues to the man-made machines during short periods. It is a short-run surplus. In short period, due to excess demand for the capital equipment, is rent arises. It disappears in the long run because the supply, such capital equipments increase in response to increased demands. Dr. Marshall explained the concept of quasi-rent in another context. In long run, the price of the commodity must cover prime cost and supplementary cost. Interest. Capital and interest in economics, a stock of resources that may be employed in the production of goods and services, and the price paid for the use of credit or money, respectively. Capital in economics is a word of many meanings. They all imply that capital is a stock by contrast with income, which is a flow. In the business world, the word capital usually refers to an item in the balance sheet representing that part of the net worth of an enterprise that has not been produced through the operations of the enterprise. In economics, the word capital is generally confined to real as opposed to merely financial assets. Circulating capital consists of goods in process, raw materials, and stocks of finished goods waiting to be sold. These goods must either be transformed, as when wheat is ground into flour, or they must change ownership, as when a stock of goods is sold. Components of gross interest. A characteristic feature of a general rise of prices is that borrowed money can be paid back with part of the commodities that have been bought by means of money and then sold. An extra profit over and above the legitimate profit of commerce, a surplus, therefore remains. Through the general rise of prices, trade boom, business prosperity, the possessor of ready money and claims to ready money, government loans, mortgages, etc. is threatened with loss, since he receives less and less commodities for his money. The rate of interest must replace what money capital loses through a rise of commodity prices. The greatest sufferers from a rise of prices are the holders of securities bearing a fixed rate of interest, for if they sell such securities, they lose through the fall in the selling price, and if they keep them, they receive less commodities. Theories of interest. Classical theory of interest rates compares the supply of savings with the demand for borrowing. The classical theory of interest rates fails to account for factors besides supply and demand that may affect interest rates, such as the creation of funds, the importance of income and wealth, and changes in the primary borrowers in an economy. A second method of determining interest rates is the liquidity preference theory. This theory asserts that economic units have a preference for liquidity over investing. The preference for liquidity can be accounted for by the fact that economic units need to hold certain levels of liquid assets for purchase of goods and services, and the fact that these near-term future expenditures can be difficult to predict. In loanable funds theory, the demand of loanable funds originates from domestic business, consumers, governments, and foreign borrowers. The rational expectations theory of interest rates is based on the idea that people formulate expectations based on all the information that is available in the market. Profit. A financial benefit that is realized when the amount of revenue gained from a business activity exceeds the expenses, costs, and taxes needed to sustain the activity. Any profit that is gained goes to the business's owners, who may or may not decide to spend it on the business. Profit is the money a business makes after accounting for all the expenses. Summary. The price charged for products and services is set artificially low in order to gain market share. Once this is achieved, the price is increased. 4 factors of production, that is land, labor, capital, and organization, are engaged to have a certain level of output. They charge prices for their services. Landlord gets rent, labor class receives wages, capitalist gets interest, and organization receives profit. Price is the value exchanged for products in marketing transactions. Price is not always money paid. Barter, the trading of products, is the oldest form of exchange. Modern economist opines that the price or remuneration of labor, that is wage, is determined by interaction of forces of demand and supply. Analysis of demand, cost, and profit relationships can be accomplished through marginal analysis or break-even analysis. An organization must determine the demand for its product. The classic demand curve is a graph of the quantity of products expected to be sold at various prices if other factors hold constant.